Hello everyone and welcome to my channel. My name is Wesley Hurd and today we will be talking about real estate, hard real estate, actual physical properties you can go see, touch, and smell. We're going to be talking about those versus REITs, which you still can see. I can see RioCan properties in Calgary, but can't really touch REIT and I probably don't want to smell it. But that's what we're going to be talking about today is REITs versus real estate. Now you might start off watching this video asking, Wesley, why would we want to talk about REITs and real estate? They're pretty much the same thing. Who cares? Whatever. Yeah, you might be right. You're still investing in the real estate asset class. That is correct. They're very, very different. REIT are on the stock market. You can invest through a TFSA, through what else can you invest through? A TFSA, your pension plan, your RSP, a non-taxable account, all that kind of stuff. And with real estate, you invest in actual real estate at the bank. That's how you do that. I've never done it before, but we're going to talk about that today. So let's start off with REITs. I am invested in 2 REITs, just to let you know. I want to be transparent. I'll put them up right here. I think it's like 62 or 68 shares of RioCan. I think I have 4 shares of Dream. I'll add the little bubbles up there somewhere if I can figure out how to do it in editing. If you know good editing tips, let me know, because I'm not very good at it, but I'll put those up there if I can figure it out. REITs are not all the same. There's many REITs. There's office REITs, there's care REITs, there's mall REIT, lots of REITs, commercial, industrial REIT, all kind of REITs. Now with properties, there's also different types of properties. There's residential real estate, commercial properties, and you can invest in like multifamily unit properties as well. So we're going to be comparing them today. I don't want to make this whole boring graph, which I actually did make a graph for this video, or a spreadsheet I should say, but it's really boring. Numbers only really tell one side of the story, and I wanted this video to be about what's best for you. Now, just because one on paper make more money may not be realistic for you. If house prices are incredibly pricey in your area, if you live in parts of Canada, Vancouver, Toronto, it's so hard to invest in real estate because a rental property is $1 million. You gotta put 100,000, 200,000 down. Well, it'll take you 10 years to save that up, and in that 10 years, you'll be investing in REITs. Some of the pros of REITs that I like is that they're so convenient. You can stay at home in your office chair with the couch behind you, computer, light, you name it. It's so convenient. You can invest on the stock market when the stock market hours are open, and that's it. You don't need to go anywhere. You don't need to talk to anyone. You don't need to have tenant interviews. None of that. You're not fixing broken things. You don't have to deal with any of that. With a REIT, obviously you have to A, do your research, B A, you have to do your research. B, you need to stay on top of the company as they buy new properties. Are they buying new properties? Those are still questions and research you need to do on a REIT. You can all do that from home on your time. I know Dream sends me a bunch of stuff. That is Dream Industrial REIT, by the way, not Dream Office REIT, as I don't think Office REIT is going to do very well. I mean, who goes to an office anymore? And the Industrial REIT, I think, is going to do quite well because I think industrial properties are positioned in this day and age to do very well. You know, people are buying a record amount of things online. New companies are coming up, entrepreneurship, all that kind of stuff. I think industrial REITs will do really well. That is my opinion. But back to REITs, they're very convenient and they're very great, and you can buy shares for as little as $15 to $20. I mean, the RioCan REIT is trading at like $14.30-40. My Dream shares are like $11.40. That makes it an awesome way to invest with $100, $50. With REITs, you can't control properties they buy, you know, who their management is, but that stuff you can research and buy into. If you like Edward Sunshine for RioCan. RioCan is a REIT that I want to invest a lot more money into. They've been paying a dividend, I have here, for over 20 years and have consistently grown their dividends over the years. That's fantastic. And I have here that Dream is invested, obviously I'm invested in Dream, that they properties in the United States, Europe, and Canada. So that gives me further geographical diversification, for a fancy word, because they have stuff in the US and in Europe, and I'm getting those currencies. That's one thing that Warren Buffett said in the shareholder meetings, that he looks for companies. Let's see if we can do this. I have a company, and they have all different kinds of dollars, whether it's pounds, dollars, euros, whatever other currencies there are. They're getting all that, and that's great for the company. That's great for the company to be be having all a different source of money, and this lets me have real estate in Europe. I'm not going to go buy a physical house in Europe, pay someone to manage that. That's ridiculous. The taxes would probably be a nightmare. If something happened to the house, I'd have to take a 12-hour flight, whatever it is. That's why I really like REITs. Just to recap, the pros of REITs is that their price point is super low. You can invest for $15, $20. Some REITs are $2 a share. Maybe I don't recommend the really cheap ones. For really cheap compared to a down payment on a home, it's super convenient for the second reason. And you don't have to leave. You never have a phone call. You never have issues with contractors. Another pro with REITs is you get lots of liquidity. If you need to sell your shares, you go on during stock trading hours and you sell your shares. That's about it. You don't have to call a realtor. You don't have to schedule an open house. You don't have to do any of that. Buy them and sell them in the same day. Obviously, maybe I don't recommend that as I am a dividend growth investor, but you could buy and sell it in the same day. And I mean, if you're at a free brokerage like Wealthsimple Trade like myself, it doesn't cost you anything. Now let's move on to hard properties or real estate. Buying real properties. Now, to be fair, I've never bought a property. I don't own a home. I don't own a rental property. But the excitement that I get from looking at properties, talking to landlords, talking to people, and being like, oh, you own 3 rental homes, talking to my landlords, you own a bunch of units. That's awesome. Like that makes me so excited. So that's definitely a big pro for me because it's very exciting. I also find myself quite handy, so I like to work with tools. I was an apprentice in 2 trades for a while. I love that. It's so much fun and so exciting for me, and so that's the biggest pro for me. That might not be for everyone. You might find it a huge pain to take care of a property, but I find it quite exciting. With that said about how excited I am, let's talk about a few kind of different strategies. With REITs, you'd buy, hold it, and you get the dividend and the capital appreciation of the stock. Physical properties, it's a little different. There's a few ways you can do it. You can buy and flip properties. You can buy and sell condos, big homes, multifamily unit homes, and you don't have to keep them for a long period of time. You buy them, fix it, sell it, get rid of it. You don't have to deal with tenants or whatnot. You do fix it up and you do flip it, you do sell it, but you buy a distressed property, you buy it, put a tenant into it, and while you sell the house that includes the tenant. Now, this is one strategy. This is not a strategy I want to do or really get into because buying and flipping homes is very difficult and extremely labor intensive. I think a more broader and better strategy for most of you is to buy and hold real estate. So you could go buy a home, maybe a duplex or kind of an up and down, and you live in one, rent out the other. They pay half of your mortgage. You build equity. Hurrah, that's awesome. You're paying less. House hacking is also what it's called. You buy it, renovate it, refinance it, and repeat. Something like that. That'd be a strategy. That's something I want to look into. You can buy a property. You could put do a value add. So you can buy a property, maybe $200,000, maybe it's worth $260,000, $250,000 if it's fixed up and has a tenant in it. And you fix it up, you can refinance it, and then you can withdraw your money in equity that you created and keep a tenant in there. Tenant is paying rent, you're getting cash flow, you're building equity in the home as they're paying off the mortgage, and you take that money out and you go do it again. And soon enough, you'll have 5, 10, 15, 20, 100,000 properties. Oh, Matt McKeever on YouTube he's over in like Ontario or Quebec or Toronto, somewhere over there in Canada, and he has like a bunch of units, and that's awesome. With that said, there's definitely some cons for real estate. With all the exciting and fun stuff that comes from real estate, there will always be more work at the beginning. You're going to have to go find the homes yourself. You're going to have to walk through them. Unless you have a lot of money already, you're going to have to do a lot of the work yourself or get it contracted out, but that'll hurt into your profit. It's going to be a lot of work. You're going to have to take the phone calls at midnight. You're going to have to go shovel the walks, unless you make them shovel the walk. It's going to be a lot more work, and you may get more cash flow. That's great. You might be getting $200 to $800 a month instead of a REIT. I get like $16 a month. With that said, meaning again, we're not going to go back into REITs because I've rambled enough. With all of that said, the biggest pro of buying real estate is being able to leverage money. You can go buy a $200,000 property with 5% down. You can put $10,000, $20,000 down, and you could have a $200,000 asset that can produce money. With REIT, you buy $100 worth of REITs, you only have $100 worth of shares, creating more profit for you. I have to say that's the biggest pro is that as you buy one property and leverage into that one can continue paying you while you leverage into more property. And that's great. That's one reason why I want to do it. But with those cons, it can be a lot harder to manage a property. You don't really have to manage a stock. With a REIT, you can come home, after work, do some research, buy it, then maybe just put in an hour a week, a couple hours every quarter, reading their reports, making sure they're on track, growing their revenues every quarter. That's all the work you need to do and put into it. It's very hands-off, extremely passive. But with hard properties or real estate, however you want to say it, it requires a lot more work up front. And once you get those systems and procedures down, if you have go-to contractors, go-to plumbers, electricians, maybe you get someone to manage the properties for you. If you get a good management company, then maybe you don't have to do so much work up front. You don't have to do so much work after everything's done, and that could be great, but those are definitely some pros and cons of both. I do want to share a few numbers and percentages with you. So for buy and hold investors for real estate properties, rental properties, multi-unit properties, from Forbes, it says you can generally expect between 7 and 10%. So that includes the price of your home going up and cash flow and tax write-off. And they also had a part in there that I like that says, although some investors can generate up to and exceeding 20%, and that really includes your skill level, because the more skill you have doing it, the better returns you can get. The REIT typically, with the 20 REITs, maybe 5 really good REIT, you can't affect the REIT in any way apart from purchasing it. And then if you look at REITs on the other hand, if you look from 1977 to 2010, REITs have generated, this is including the capital appreciation and dividends, about 12%, and this includes for inflation. So that's really, really good actually. REITs get a ton of capital appreciation from REITs, sorry, not REITs. Some REITs reek, some don't reek. I like REITs. You mostly get dividends or distributions from REITs, and this is great. I get a monthly cash flow every single month, and I can put that right back into REITs or other stocks if I'd like. I hope you found this information useful, and I want to leave by kind of answering the question that you had. The reason you clicked on this video is, should you buy REITs or real estate? Now, it super depends on your position, how much money you have, how much time you can put into it. But I want to give you, right now I'm investing in REITs. I don't have a big chunk of change for a down payment at $10,000-$20,000 for Alberta, because house prices are quite a bit. Maybe when house prices come down, I can put less down. Maybe I can get into something, but I want to still be investing and saving money in the moment. Just because I can't buy into real estate doesn't mean I can't benefit from real estate, and that's REIT. So for me, it's REITs. If you have time, maybe you're already in a trade, that could be great for you. If you have the money, go put money down. And I suggest, if you can't but really want to, also like myself, I really want to, I want to get into it. That makes me so excited. I love just looking at properties all day. The ones I'm not going to buy, they're awesome to look at. It's fun, it's exciting. What you can do is invest into REITs, and 2 or 3, 4 years, however long it takes you to save up that down payment, is invest into REITs. And as you go invest into REITs the beginning year, go next year, your REITs are growing bigger, you're already getting more monthly cash flow, and you keep saving money into your tax account. Preferably not your TFSA, because you don't really want to be pulling money out of there. But let's say you do, you've built up 10, 20, 30,000 in your tax-free savings account. You can pull that money out for down payments. Now, don't just go do a down payment on just some regular Joe Blow house. Go get maybe a duplex you can rent out the half. Get a place where you can either renovate the basement with the unit down there, or buy one with the unit already put in, and use that real estate as an asset. You don't want to be buying a home that doesn't generate you anything. That's a big misconception I'm going to do another video about. But don't buy a home and expect it to be an asset, because your home doesn't make you any money. House prices may raise a few percent a year, but so does inflation. You're not pulling any cash out. You're just putting money in, and you're paying interest year after year for 25, 30 years. That's no proper asset. Your asset needs to be paying you, needs to be giving you some kind of monthly cash flow, which is what this YouTube video is all about. Is about growing your monthly cash flows, your distributions, and using that to continually grow that, to have future passive income, to be able to retire early and to buy your time back. I love that about investing. Investing is spending money to buy your time back. That's how I want to leave today's video. I really hope you enjoyed it, and stick around for